1031. Thank you so much for being here. Thank you. Absolutely. All right. Morning. Morning. I'm Tiffany with Kelly's Organic. I think I know everybody's. Good to see y'all. So I was asked to go over 1031s. I kind of want to give you an idea of why, or what the presentation's goal is. I don't expect anybody to be a 1031 expert. I'm not a 1031 expert. But it's a really cool tool if you know about them enough to spot when it may be a good idea for your clients. So you're out showing somebody property, they're talking about, well, we're going to sell some land that we inherited or whatever it is, and repurchase. If you hear that back-to-back thought, or once we sell this, we're going to reinvest in some rental property, something like that. If you hear them talking, it may be a good time for your ears to perk up and think, hey, this may be a good fit for a 1031. One, because you're going to save your clients money. Two, you get two transactions instead of one. And they're normally, they have to be pretty close together. So it's not like it's going to be 4 years down the road. Make sure I know how to use this thing. Okay, good. So what is a 1031 exchange? The number comes from, it refers to section 1031 of the IRS code. No gain or loss is recognized when a property held for productive use in trade or business or for investment is exchanged solely for replacement property of like kind, which is to be held for productive use in trade or business or for investment. So you'll see the key thing missing there is it's not the home you live in. It's a productive property held for trade or business or investment. So it's not to be used on primary residence. And we're going to go into what like kind is and all that in great detail in just a moment. So reasons to exchange. Deferral of capital gains tax, deferral of depreciation recapture, improved cash flow, greater purchasing power, build and preserve wealth, estate planning for heirs, relocate to other geographic areas, and diversity or consolidation of real estate assets. So I'm going to talk just briefly about those. So deferral of capital gains. The capital gains doesn't go away. It's a deferral. So instead of paying a tax on this transaction, you could defer it multiple times. You can do 5 1031s in a row and defer it all the way to the end. We'll get more into that. Deferral of depreciated recapture. This is where I'm like dangerously educated on, like just enough to be dangerous. Recapture rate on depreciation is, tax codes change every year. This is one that I don't even toy with trying to talk about too much, but you can defer that as well. Improved cash flow, so say you have land that is not producing any rent or anything like that. You can sell vacant land and buy an investment property that's worth the same amount of money, 500, and this one's producing cash flow, whereas the other one wasn't. And then greater purchasing power, if you have all the money from your sale to purchase versus taking 30% off the top for capital gains, you've got more money to spend. Build and preserve wealth, that kind of goes along with what we've already been talking about. Estate planning, however that fits into your estate planning model. Relocate to other geographic areas. So you've got 10 rental properties in Georgia and you want to relocate to Arizona, you want your rental properties to be there, but you don't want to pay all the taxes on selling all these rentals that you've owned forever. I did one for a couple. I had one couple that sold one rental property in New York and they were able to buy 10 rental properties in Georgia. They were moving back south. But that's, they just were, this was, a decade or so ago. So they had a lot more purchasing power with that much money from New York down here. So you can imagine what that did with their cash flow. It was like phenomenal. So that's the reasons why you look for a 1031 exchange, or why people with land do. All right, it says the full exchange on here. I don't know why it doesn't say it up there. Yeah, I printed this from that. So tax benefits. This is just a very simple example, but say you've got a property that's got $1 million equity. If you do a 1031 exchange, your basis is $100,000. Like, good for you. You invested in 2006 or 8, and your gain is of $900,000. If you do a full 1031 exchange, which we're going to talk about full versus partial, your estimated tax right now is none. If you have $1 million equity, basis of $100,000, your gain is $900,000. You're looking at about $225,000 with income taxes. So that's capital gains taxes. Those are all based on your tax bracket, but that's a pretty accurate number. So who would want 250 more?
That's all right.
Okay, so we're going to kind of go through how it works. The first thing to start with the 1031 exchange, once you've identified somebody who might benefit for this, is to contact a qualified intermediary. That is a disinterested third party that has not acted as an agent of the taxpayer within the last 2 years. They cannot be a related party to the taxpayer. There are a couple of fabulous 1031 companies that we work with a lot. I'm happy to send referrals to anybody. I always give a couple just because not everyone's the right fit for everybody. There are also some poor ones with really poor reputations. Like Google's a good place to look. Look at their reputations. Were they easy to work with? I would not want someone holding my $1 million for, 6 months if they didn't have a good financial backing, a good bank. You want to read the reviews. You don't want a fly-by-night company that you don't know who's holding all the money. Next slide. And then their role in the transaction. They document the exchange for the taxpayer. They coordinate with the settlement agent on each of the closing. They act as the principal in the sale of the relinquished property and purchase of the replacement property through the assignment of contracts. They receive the net proceeds from the relinquished property. They fund the replacement property purchase, and they're required to facilitate a 1031 exchange. A QI is not required if two parties swap with each other. I have never closed one of those where there's not been a QI, because then they have to do all the tax forms by themselves. So even on ones that I've only closed 1 or 2 swaps in my career, but even those used a QI just to do all the back end paperwork for them. It's worth the $500 in my opinion. So when I say document the exchange, there's a lot of paperwork that goes along with the IRS code 1031. So they've got to do all the paperwork behind the scenes. Coordinating with us, they send us documents that have to be signed by the purchaser and the seller on both sides of the transaction. So whether they're selling the property and taking that money and putting it into a 1031 or taking it out to purchase, there's documents that both parties have to sign. That's where you guys kind of come in. There are also special stipulations in the contract. So if you look in the GAR special stips forms, there's special stips to use if your seller is intending to put their money into a 1031, and there's a special stip that if your buyer is using 1031 money. You want to make sure to use those because the QI acts as a principal in the transaction. So when we have the funds, we don't send them directly to the seller. We send them to the QI, and then the money comes from the QI. So they're acting as like the purchaser and seller in the transaction. And so there's an assignment to them of rights in the contract. It's required for that to be in there. And that also, those special steps state that the other party will work with the buyer or seller in signing anything that's required from the 1031, and they always have stuff to sign. So you want to make sure to use those. If you have a contract and then they decide, you can always add it. Not like life or death. They receive the proceeds from the relinquished property. When you sell and you want to do a 1031 exchange, you cannot touch the money at all. So if they walk out of my office with a check and we've cut a check to them, I can't turn around and then say, I want to do a 1031 and just not take the money. The money has to go directly from our account to the 1031 qualified intermediary. If they touch it at all, it's done. So there's just no chance of it. There's not penalties. So say you decide to do a 1031, we send the money to the QI, and then they are never able to identify a property that they want to purchase. There's not a tax consequence. There's not a penalty, but you just end up paying whatever you would have paid if you had not gone through the 1031 process at all. I think like a couple $100 to the QI. They fund the replacement property purchase. So when we're ready to purchase the new property, they're the ones that send the money over. So normally with that, we have to, actually on both sides, there's normally like a 48-hour window where we have to get everything to the QI on either side for them to sign off on first. So just a little bit more of a timing thing. And then they're required. If the parties are going to do one, they have to have a qualified intermediary. Choosing one. Oh, I got ahead of myself. Look for a company that has financial strength, a fidelity bond, professional liability insurance experience, and then segregated accounts for their QI funds. All right. This is just kind of a structuring of this is a fully deferred exchange, and then we're going to go through partially. So this was like what we were talking about earlier, just $1 million sales price. they've got a loan payoff, so that, obviously just goes directly to the loan. They've got net proceeds to the QI is 800,000. The replacement property, they purchase one that's 1.1 million. They get a new loan of 300, and then they use the full proceeds, which is the 800,000. So that's a fully deferred exchange. They've used all the money. They've purchased something that uses everything. That's kind of like a perfect example, which, as you can imagine, rarely happens. It's not, real estate's not apples for apples all the time. So this is an example of a partially deferred exchange. This one, you've got a sales price on the relinquished property of $1 million. Same thing, mortgage payoff of 200, proceeds are 800,000. On this new one, the purchase price is 1.1. They have a new loan of 400,000. So the proceeds from the QI, they're holding 800. They only send 700 because that's all that's needed. And then that's called the taxable boot. So that 100,000 that's left over is what the sellers take. And they pay taxes on just that amount right now instead of the full 800. They would pay their capital gains of 100,000. Because a lot of people do need some money from the sale. They're purchasing a property they want to rehab or renovate. They want to go on a nice vacation, buy a car, pay for tuition, whatever it is. Just have some money. So you can't structure it like that, where you take some money out, just pay the tax on that portion that you take out, which is called the taxable boot. Another example of partial, same thing. This is an example with a lower price. So they sell $1 million, they purchase 900,000, take out a lower loan. So that's wrong. Ignore that slide. We'll take it up with David, who did these slides. But if you purchase property that's less, we'll go into that in a minute. So like what you're looking for in the exchange. All right. So the process, the contract for the sale of the relinquished property, you want to include the 1031 cooperation clause, which is what I was talking about. This is addressed in the GAR special steps. So notwithstanding anything, buyer hereby acknowledges that the intent of the seller is to effect a 1031 deferred exchange, which will not delay closing, blah, blah, blah. Buyer agrees to cooperate with seller and the QI in any manner necessary. So that's the language you really want. Then you engage the qualified intermediary. They coordinate the closing, and then they prepare the exchange documents and agreement and the instructions to closing attorney. Closing on the sale. So the exchange documents are executed prior to or on the day of closing. Taxpayer signs a settlement statement. Property is deeded from the taxpayer to the buyer. Exchange proceeds are wired to the QI. And then the exchange timeline begins. So the relinquished property closing date is day 0 of the 180-day period. The replacement property must be identified within 45 days, and then they have the 180 days to close. The 180-day exchange deadline may be shortened by tax filing dates. So I always tell people, talk to a QI, because it depends on if you file your taxes in April, if you file in October, it can mess with your 180 days. Depending on, like, if you sold the house in 2025 and you're purchasing in 2026, but you're paying taxes in April, you may not have the full 180 days. That's just tax math. I don't know. And then once you've identified the replacement property, these are the rules. So you can do a 3-property rule, up to 3 properties without regard to value. 200% rule, any number of properties, provided that the total aggregate value doesn't exceed 200% of the relinquished property value. So that's like with my New York example, the 10 properties they purchased couldn't exceed 200% more than what the relinquished property was. And then the 95% exception, any number of properties for any value, but you must acquire 95% of the total aggregate value of all identified properties. Again, don't expect anybody to be an expert, just know there's some rules. Identification requirements. The notice must be in writing to the IRS. So you tell the QI, I've identified it, they provide the notice. The property must be unambiguously described. So you can't, what that is we're going to you can't say I'm going to purchase 17 acres of this 100-acre tract and not identify what 17 acres it is. So it has to, if you get a survey and it's changed just a little bit, that's totally fine. But you have to identify specifically what you're purchasing. Or you can't say like a condo in this condo unit. It has to be the condo that you're purchasing. And then property acquired by taxpayer must be substantially the same as the property identified. We're going to go into more about that, but really it's income producing. Like you can exchange vacant land for duplex, so it's not as restrictive as that sounds. Step 6, you contract for the purchase of the identified replacement property. You can enter into a contract for the purchase of the replacement property at any time. It should include the cooperation clause again. QI prepares the exchange documents and closing instructions, and then you close on the purchase of the replacement property. The 1031 documents are executed before closing. Taxpayer signs the settlement statement approving the amount of the 1031 exchange account funding, and then the QI wires the funds from what they were holding to the purchase of the property. It sounds like a lot. It's actually really simple. Like we do it all the time. It's not bad at all. So structuring a fully deferred exchange, the replacement property must be equal or greater in value. So that was what that example that I said wasn't great, was trying to explain that if you purchase something less than what your equal or lesser value, you may have a taxable boot there. You must reinvest all net proceeds into the replacement property or properties and must replace any debt. So that was where that kind of came into play. If you had a $300,000 loan and you're only taking out a $200,000 loan, you're going to owe, that's going to be a taxable boot there because you have to replace any debt that you had. A taxable boot can occur when you're falling short of their investment requirements or the application of the 1031 funds towards toward unacceptable closing costs. And that's where good QI really comes into play, because there are some things you can pay for, there's some things you can't, as far as what's considered money you can use, or
the funds you can use, or what you can pay for it.
Other exchange structures. So a reverse exchange allows for a purchase of a replacement property before the sale of the relinquished property. I have never closed one of those, but we have at the firm. So you are buying whatever it is you're buying, and you know you're going to be selling a property, and you want to use you want the taxable value gain from that. You can set it up that way if you've got enough money to purchase that new one first. But again, good QI to have all the tax forms in order. Improvement exchanges. So allows for capital improvements on the replacement property on a tax deferred basis. Same thing, it has to be given to the IRS exactly what improvements you're going to do so that you don't end up paying the taxes on that amount.
So would that be where like that taxable boot amount could be used? Or am I not understanding that right?
That would be a way to prevent a taxable boot.
Okay.
So you wouldn't have a boot if you're using it for improvement.
Okay.
All right, important considerations. Like-kind property, we're going to go into in just a minute. Title vesting. The title has to be exactly the same. So if I own my relinquished property as Tiffany T. McWhorter, I'm purchasing the replacement property as Tiffany T. McWhorter. It can't be like Jason and I own something and only one of us is buying it. It has to be exactly the same as what it was. Can be related parties. The holding requirements, are different for different types of property. So this is also where I get kind of dangerous on, like, vacant land depreciates at a different rate than an apartment complex or something like that. So the holding requirements of how long you've owned something before you could do a 1031 exchange are different. So again, good QI will tell you all that. Restricted access to exchange funds. Like I said, they cannot touch the funds at all. Doesn't apply to vacation second homes unless, now you will hear people doing it with like VRBOs, ones that are truly owned for investment purposes that they use sometimes. There's like limitations on how long you can use it and all that. Impact closing cost, QI, and then the role of the realtor. The role of the realtor, in my opinion, is just helping them identify it, helping them find a good QI, or not find a good QI, encourage them to find a good QI. All right, this is the slide I was trying to get to. So important considerations, the definition of like-kind. So all real estate is considered to be like-kind to each other in a real estate exchange under the IRS section 1031, provided it's held for long-term investment, income-producing purposes, or productive use in a trade or business. So example of exchangeable real estate include, you can exchange any of these for the other. a commercial building, residential rental, raw land, a working farm, a vacation or second home. And you'll see the asterisk is that the rental requirements, personal usage restrictions on any type of vacation or second home. So you don't have to exchange raw land for raw land. You can do raw land for a commercial building, do any of these for each other. And then the title vesting, we talked about the title of the taxpayer seeking the tax deferral. They must replace the purchased property in the exact name. Related parties. Related party must hold the property received for a minimum of 2 years before selling. So if a parent wants to do a 1031 exchange, they're selling it to a child, that person has to own the property for at least 2 years, or there could be back taxes. And then taxpayer must hold replacement property for a minimum of 2 years before selling. Purchasing from a related party, again, taxpayers cannot purchase replacement property from related parties unless related party also completes a 1031. Both parties must hold respective properties for a minimum of 2 years before reselling. I don't know if I've ever done related parties, to be honest. Holding period. So properties included in 1031 must meet IRS holding requirements. There's no clearly defined amount of time. It's based on intent. How they determine taxpayer intent, I don't know. The length of time property held for qualified purposes is an indicator of the taxpayer's intent. Property held for resale purposes does not qualify. So what that is saying is if you're selling a rental property and you want to purchase a flip, that's not going to qualify. Anything that you're purchasing just to redo and sell real quick is not going to qualify. So you can't just constantly do a 1031 on properties that you're flipping. And then dealer inventory does not qualify. I don't even know what that means. Restricted access to the funds. They can't have access or control on any of the funds. QI can only release proceeds for purchases of identified replacement property. If unable to purchase ID property, the QI is obligated to hold funds until the 180 days expires. If no property is identified within that 45 days, they can close out the 1031 exchange account first business day after the identification period expires. All right, closing cost. Again, this is where QI is going to come in and tell you what's allowed and what's not. Generally speaking, non-reoccurring costs solely associated with the sale or purchase of an exchange property can be paid through closing on a tax-deductible basis. So real estate commissions, exchange fees, attorney fees, CPA fees, you can use proceeds, the 1031 proceeds to pay for all those. Generally speaking, costs that are reoccurring in nature associated with ownership are not paid on a tax-deferred basis. So things like security deposit prorations, rent prorations, credit to buyer for closing expenses, credit for repairs, fees related to obtaining a new mortgage. And they are really specific. Like when we get our closing instructions, it's like, this is exactly how these have to be worded. It has to be named like this. There's never really any question about what's covered and what's not. Role of the realtor, spotting potential 1031. So you're listing a property that's a rental, that's vacant, that's commercial real estate or raw land. Those are, 4 really good indicators that that might be a good person to, if they're going to reinvest, to do a 1031. And contracts include cooperation clause. We've said that a couple times. And then purchase replacement property must be the same person's in the same names. So if you're working with someone, make sure that you've looked at the sale. This is how it has to be on the purchase. The names have to match up exactly. And that's something that the QI will correct. We do that all the time. Hey, I see that the person, you have the new purchase contract without a middle name. Please add middle name. They're looking out for stuff like that. Again, role of the realtor, make sure that they've engaged a QI prior to closing. Get all 1031 documents and closing instructions signed or prepared prior to closing. Aid the taxpayer in your active search for replacement property as soon as possible. Remember time restrictions. And then the benefit would be the opportunity to assist with multiple transactions to close within a short time period. So that's where you guys might benefit from them. And then 1031s is a wealth building strategy. So you can exchange, like we talked about earlier, non-performing assets for cash flow property, leverage equity from one relinquished property into multiple properties to increase cash flow, leverage equity from several smaller relinquished properties to upgrade to a larger income producing property. And you can continue to exchange, and if never selling outright, you just continue to defer those capital gains until you stop doing 1031s. Heirs inherit properties on a stepped up basis. So if as long as you're purchasing property, whatever the value is at the time of the taxpayer's death is what the basis in the property is for their heirs. So you can continue to just grow that value without paying taxes on it, and then your heirs never pay taxes on it. So it's a pretty cool method to avoid taxes that way. That's all I got. I was talking really fast. Sorry. Do you have any questions? Are you seeing people talk about these, or you don't have any interest at all? I mean, we close them pretty regularly. I think I know a few agents who have kind of made that their area of expertise and do really well with it. Identifying people who are selling land and buying.
I've never seen second home or vacation home on that list before.
Yeah.
How does that work? Do they have to be income producing?
It has to be income producing. So really it's like VRBO type stuff. And there are really strict limits on how much the owner can use it. So you can use it some,
Yeah.
but same thing, Todd, you probably weigh in, like if you're getting a loan.
It's gonna be an investment.
Yeah.
That's by 1031, they can't do a second
Home
home
loan.
on it because for a second home loan, there can be no restrictions on what you can do with the property. So
Any other questions? Yes, ma'am.
What is the cost if you were to do the sell, the buy, like roughly?
Yeah.
$1,000, couple hundred, what,
Right around 1,000.
right about $1,000?
So I normally see about 500 transactions,
Is that for the QI?
the QI.
Okay.
And there's no additional cost on our end, no additional costs as far as agents go.
it's a really good deal.
Mm-hmm. So for the tax stuff, so I know we talked about the heirs. If, say, somebody started this and they did this for 20 years and just kept going, and do they pay the tax rate at the time they finally stop doing it and want to cash it out, or the tax rate when they initiated the first one?
The end.
The end. Okay. A lot of people's tax brackets
Go up.
change.
Yeah, and some go down.
Yeah, some go down. Yeah, based on their retirement,
Mhm.
like what that looks like. But okay.
So, I mean, I did one last year, and the property they were selling, to buy my listing, I guess the knowledge or to be able to walk your seller through what could potentially happen. We had a lot of delays because that sale was a commercial sale, and there was a lot of delays. So I guess, how do we protect our seller in the verbiage on the contract and stuff like that to make sure that they know, I can communicate to the seller, or we can communicate to our seller or our buyer, that it can mean we might need delays because of this process.
So I guess the question to ask if you're a listing agent and you're getting a purchase offer that has 1031 language in it, so it's coming from the 1031, would be to ask, has the relinquished property already closed or not? Because it sounds like in your case it hadn't.
It had not, but it had a contract that was supposed to close, within like nine days. And I had a copy of the contract and everything, as we all know, things happen.
Exactly. Yeah. I mean,
and it kept happening because it was a commercial and property. So just somebody who maybe I'm not as familiar with, commercial properties and how those delays can potentially happen. Just, I guess, throwing it out there from experience, that there could be some delays if it hasn't officially closed.
if it hasn't closed yet. Yeah, and I think that's a great question to have in your toolbox, like if you are accepting offers, because there's really nothing you can do about that, but you can at least prepare your client for it, because it's the same thing as if you get one that's contingent on the sale of real property. But that's a really good in action kind of tidbit to take. I'll give you one other tip, kind of goes along with that. If you are accepting an offer from a cash buyer who's using 1031 in funds, make sure your seller's intending to sell. There was one we had that the sellers backed out last minute. The buyers had identified that property. If that one didn't close, they were going to end up having to pay the taxes because they were past their 45-day period. They were pushing their 180-day period. So if that one didn't close, then they were just going to have to take the taxable amount. So they ended up suing. Like they literally walked out of my office in Buford, walked to the front of the building, stopped by one of the litigation firms there. There's two, conveniently. And they filed, like they literally, like this is like on a Wednesday, by Friday they were closing because they threatened everything under the sun against the seller, who had just changed their mind. They didn't want to sell the property, and they ended up selling because it was going to be a huge tax disadvantage for the couple that was purchasing. So if you are accepting offers with 1031 funds, just make sure your sellers, for sure, they want to sell, because that could happen for sure. I'm trying to think of any other like practical tips. I mean, for you guys, really, it's like just identifying it as a possible 1031, because your role is very limited in what you have to actually do. Once the QI steps in, they're like, this is the paperwork, this is what you need to do. They tell us what to do. They tell y'all what to do. They tell the taxpayer what to do. It's really, they kind of orchestrate the whole thing.
Mm-hmm.
We use a few, if you ever need recommendations, I can give you some good ones. Rachel, who came in and taught a class on 1031s, has been working with our firm for years. Atlanta Deferred Exchange does a really good job. They're very financially sound. See them. Yeah, I hate that save one sometimes, but we use, we do. Anybody?
So your advice, so I have a client who may actually be interested in this, so my role is get them in touch with
A
a good QI, and then they will take it from there to answer all their questions and make sure it's going to be a good fit for him.
And then when you're, listing and showing or stuff like that, make sure you understand. I think your role would be like making sure that it's like kind property and that it has to be investment. It has to be not, because a lot of people ask me for a referral to a QI for their primary residence. Like, we want to sell, and I walk them through like, well, not only is that not allowed, you don't need it. You've got a $250,000, $500,000, tax break already on that. So it's more just a knowledge thing on what they're looking for.
I would say that's we just did a couple last month, and it's that dance of, you're trying to make an offer. This was like a big farm that was selling and it hadn't closed yet. So that made it difficult for, they may be able to identify, but couldn't get a contract accepted. And so it was really close to the end, right before closing. And if you finally got a contract on, then they were wanting to buy multiple properties. And you got that 45-day window to get it under contract, get it inspected, to know, this is the one. And so in this particular one, it was going to be, if they didn't find that second property, they were just going to have to pay cash. They were still going to have like $250,000 that they were going to pay taxes on. But luckily they found something and were able to do it. But that was the toughest part, was the finding, identifying, get it under contract and inspected.
Mm-hmm.
And it's good to know, like, Southeast works with it, because a lot of people do get loans at 1031s also. People think of it as strictly cash, and it's not. Like, if you have debt on the property you're selling, you have to replace that debt, or you end up paying taxes on whatever that the value is.
Mm-hmm.
When you said that, you have to replace that debt.
You have to replace the debt. So on that example, but a $1 million property you sell has a $200,000 loan, you have an $800,000 gain. If you purchase $1 million property but only take out a $100,000 loan, you still have a $100,000 gain. Even though the property values are the same, you have to replace the same amount of debt, the same amount or higher.
I feel like the biggest thing in this is just understanding that if you are a listing agent and you have a buyer come in, and if they haven't, and it's a 1031, but like the thing that Thea was talking about, and they haven't closed yet, that you get into some really strict timelines, and just educating your seller to understand what the risks are.
Yeah, I mean, it's probably just as, if not more risky than contingent to sell a primary residence, because those properties can be a little iffier.
I feel like it might be a little bit riskier,
Yeah.
especially because, based on the price, the tax burden that they could face if it falls through, and if people are suing, 2 days later, it could get a little nasty.
Tiffany, could they put more money into the deal and then not take out the debt? If we, say they bought a, well.
You have to replace the debt, whatever debt you don't replace it, yeah. It's tax.
But if there was no debt, like the one that I had, they could have paid cash because they didn't have to replace it.
Yeah, whatever debt you don't replace, that's tax. Good question. Yeah, Paul, if you have any questions, and again, I'm happy to send referrals. My suggestion with all referrals is like send a couple. I don't like to be the source of the source, not the the direct
Be the
source.
source of the source, not the
The
source.
source.
Uh-huh.
Source of source.
We talked about this, be the source of the source, not the source.
Uh-huh.
Yeah.
Thank you guys.
Awesome.
Thank you.
Thank you.